Okay, let's dig into this. We've got the November 2025 Idaho Commercial Real Estate Market Report in front of us. Our whole mission here is to, give you the shortcut to what really matters in this market, especially as Idaho is sort of navigating these new economic currents.
Exactly. And the central narrative here, I think, is what we're calling sophisticated recalibration. Idaho isn't in a crisis, not at all, but the market is, it's no longer a monolith. We're seeing a really profound decoupling of asset performance.
A decoupling. So, like, success in one area doesn't mean success in another.
Zero correlation. What happens in industrial has no bearing on office right now.
Okay, so if the state is still so resilient, what's the fundamental tension here? Because you've got this historically tight labor market. I mean, Idaho Falls is around 3.2% unemployment, but that strength seems to be clashing with these huge supply side problems and some fiscal issues on the horizon.
That tension is absolutely the story. But before we even get to supply, we have to look at the long-term labor picture. And that brings us to the demographic cliff. It's the quiet structural risk in this entire report.
The demographic lift. Okay, what's the bottom line on that?
The population age 65 and up is just skyrocketing. By the mid-2030s, we're talking nearly 20% of Idaho's population. That's up from just 11% back in 2004.
Wow.
But here's the kicker stat, the youth deficit. Right now, there are only 68% as many infants as there are 18-year-olds.
68%. So what does that do to the economy long term beyond, the obvious boost for medical office buildings and senior housing?
Well, it puts a tremendous long-term chokehold on the labor force pipeline. Think about all the entry-level jobs in manufacturing and distribution. It forces employers to either automate or, frankly, to leave. And this demographic crunch, it also makes another problem worse. The state budget.
The budget crunch. Right. Let's talk about that.
State sales tax collections. They're a pretty good proxy for retail activity. And they just missed their budget forecast by nearly 10%.
Why? What happened?
It's partly due to policy changes, like the One Big Beautiful Bill Act, which was a big package of tax cuts. Now, that's great for taxpayers, of course, but the immediate result is less state revenue.
And that trickles down.
It has to. It puts more pressure on local governments to raise property taxes, to fund everything. And that's a direct cost that CRE tenants have to bear.
Okay, let's pivot to industrial, because this is where that decoupling you mentioned gets really aggressive. It's a tale of two Idahos.
It really is. You look at the Treasure Valley, the Boise area, and vacancy hit 8.9%. That's a high number.
And that's just because of all the new buildings coming online.
Purely. It's a supply shock. 4.3 million square feet just got delivered. But even within that, the divergence is fascinating. Manufacturing rents are surging up 12% quarter over quarter.
12%.
Yeah, and that's driven by massive capital from semiconductor players like Micron. They need very specific specialized space, and they'll pay for it.
But if you're just in general, warehouse distribution, your rents are flat, and then you go to North Idaho and the Post-Falls industrial market is in a genuine crisis.
Crisis is the right word. The report shows the vacancy rate has spiked to, it's an almost unbelievable 31.2%.
31.2%? That's not a soft market. That is a collapse.
It's a total collapse. And when you see a number like that, the entire power dynamic shifts. Lease rates up there are dropping down to around 93 cents per square foot. And then tenants have all the leverage.
Okay, so let's flip to office and retail, because here you have this surprising resilience. The national office market is struggling, right? Vacancy is 25% in some places, but Boise is holding at 11.8%. Why?
It's really about practical local factors. You're talking about a 20 or 25-minute commute. That makes going into the office bearable. Plus, you have a strong corporate culture here that really emphasizes being in the office. The flight to quality is real, but the best buildings are full.
And retail is adapting. The whole retail apocalypse narrative feels dead. Boise Town Square posted 12.2% year-over-year foot traffic growth. That crushes the national average.
And that growth is completely driven by what the report calls the in and out halo effect. The lesson is you anchor your properties with experiences, with dining, with entertainment, not just stores selling clothes. Those are your new traffic drivers.
So to wrap this all up for you, Idaho has really shifted. It's moved from that boomtown volatility to more of an established regional player discipline. The era of just throwing money at the market and winning it's over.
Absolutely over, which means you need what the report calls sniper-like precision. And based on their investment matrix, the single clearest recommendation they make is to sell Class B office assets. The flight to quality is just going to keep draining your tenants unless you're ready to sink a massive amount of capital into renovations.
All right, a final critical thought to leave you with, connecting all these dots. Given those state revenue shortfalls from the tax cuts and the budget pressure that creates, what specific local infrastructure projects think highway expansions out in Canyon County might get delayed? And more importantly, how would those delays directly impact the future value of industrial land in those exact areas? Something to chew on.